Welcome to It's the Economy. The US dollar is the reserve currency and hence the US 10-year yield is going to be the default interest rate of the world. Now, the rise in the US yields from 3.5% in June to 3.75% in July to 4.3% in August is actually impacting macros of all countries because this is the default rate of the world. Now, what explains the rise in these yields and will it continue to rise at these levels? Because if it will, then it's going to impact all of us. For these questions on US yields, I'm joined by Robert Sockin, the chief economist at Citibank, the global economist at Citibank, and Steve Englander, head of macros and North America research at Standard Chartered. Good evening to you, gentlemen. Thank you very much for staying up on a Sunday night for us. Well, first, let me come to you, Robert. What has caused such a significant jump in US yields, according to you? Is it Fitch downgrade? Is it just FOMC minutes? Just explain to us.
This is really the critical question that's driving markets right now. So I would point to a range of factors leading yields to rise so significantly over the last month, as you highlighted. The first and foremost would be the resilience of the U.S. economy and the amount of strength that we're seeing at this stage of the cycle. You can point to a wide range of data that highlight that. You know, we've seen continued strong labor market data, strong retail sales figures, strong housing data, and given the amount of rate hikes we've seen in the cycle, if you go back several months ago, we would have expected the economy to slow down a lot more. So it's this ongoing resilience that I think is convincing markets that not only is the economy performing better than expected with these rate hikes, but that might mean that any expectations for rate cuts have to get pushed out further into the future, and it may also be that beyond that, rates have to stay higher for longer, and that inflation will stay higher for longer as well. So I think it's a combination of the macro first and foremost that's been driving this move up in yields. After that, you can point to a few other factors. I think the downgrade may be brought front and center to investors, the size of U.S. deficits that we're likely to see. I don't think the downgrade itself was the cause of yields rising, but maybe it brought more to attention the size of deficits we're likely to see. And, you know, that's another, you're getting to the deficits themselves, that's another factor that's likely led to an increase in yields, is that the market's going to have to digest a lot of supply that's coming on, given the size of the deficits the government's running at this stage. And finally, a more minor factor I point to is interest rate policy around the world. You know, the Bank of Japan loosened up the yield curve control policy that they had in place, and that's going to shift some demand for U.S. bonds back into Japan. So putting all of that together, it's not that surprising that you've seen such a pickup in yields, but I really think first and foremost, it's the macro that's driving it. It's the strength of the U.S. economy. It's the potential for higher for longer.
I take your point, Robert, but let me get Steve in. Steve, you know, the FOMC minutes was the last in the list. Yields had risen even before the minutes, and they rose sharply because of the Fitch downgrade, highlighting the very large US deficit for at least 2-3 years to come. So now, even if the Fed doesn't hike rates, are yields likely to remain high because of this US fiscal deficit and bond oversupply?
I think it's possible, and you have to be, you know, properly humble about the ability to future on this. I think that the U.S. economy is slowing, and I think that when that evidence becomes more concrete, we will see some downward pressure on long-term yields. I think the inflation numbers are going to be, you know, very low for the next couple of months. It will take the pressure off of the Fed around making. So I think in the very short term, this feels very much like a momentum trend. When I talk to my traders, the sense I get is that it's short-term traders, people who follow short-term models, that they are the biggest drivers of this. When that can turn around pretty quickly. So even though there's nothing that's immediately visible in the future to reverse this trend, I'd say, I'm more optimistic that maybe we'll see some downside to U.S. yields in the coming months. Not huge, but some. Then that it will keep on rising.
Okay, so you do see some downsides to US yields, but you're predicating that on lower inflation. But is Robert agreeable on that? Robert, what's your estimate of inflation in the US? And do you think the Fed is maximum one and done? Or may it go even higher?
These are the central questions right now. Right now, starting with the Fed, we think they're likely to pause at their next meeting. I think at Jackson Hole, Powell is going to strike a balanced tone where he's going to emphasize that they're data dependent. It's uncertain how far they're going to have to go. But wherever they stop, that rates are likely going to have to stay high for a longer period of time. So I think he'll sound very similar to how he sounded in recent weeks. But we think eventually it's going to spell one more rate hike for the Fed in November, given that we think it's going to take a while for that services inflation to come down in the U.S. economy. We're seeing a lot of improvement on the goods side. I think that's likely to continue. That's both on the food and energy side, but also core goods side. But it's that non-shelter services inflation that's likely to remain sticky as long as the labor market remains as tight as it is, and it's probably going to take a while to come down. So I think we have one more for the Fed. I think it's possible that if inflation proves even stickier and activity continues to be as strong as it is, that you could see the Fed go even higher from there. It's very hard to pin down, I think, the terminal rate once you're close to the end of the cycle within 25 to 50 basis points. But I do think wherever they end up, I think that it's going to take a while for inflation to come down, and so the bar for rate cuts is very high. So wherever they end up, I think it's going to be higher for longer from wherever they stop.
Okay. All right. Steve, what's your sense? You are expecting yields to come lower. What's your range for the 10-year for the rest of the year? Does it go below 4?
Yeah, that's a very tough question because to my mind, it's a question of market momentum, which is clearly to the upside. And certainly, from a trading viewpoint, no dividend yield seems to last very long. So the inclination among traders is to, and anytime yields go down, to sort of short bonds and drive it right back up again. But I think the fundamentals are actually for yields to be somewhat lower, to go somewhat lower, at least for a while, than where they are now. I don't think. I think the market has backed away too far from the idea that the economy is slowing down. I think it's hard clear that the economy is slowing down. And, I agree. I think this was right to downgrade in the U.S. I don't think it's an immediate issue in terms of, any sort of risk on the U.S. side. So my suspicion is that the, trading can go up any day of the week, but that ultimately there are gravitational forces that will pull yields back down, probably below 4%.
Oh, probably below 4%. Okay, Robert, you're less sanguine about inflation coming down, but do you think China will be a disinflationary force?
Yeah, that's a great question. And, China's been one of, at least from my perspective, one of the more surprising elements within the global economy this year. We had a very strong forecast for China several months ago of around 6%. And then the data have just been coming in across the board a week, including on the inflation side where inflation pressures are extremely muted. And unlike other parts of the world, China's running the risk of too little instead of too much inflation. So I do think that's a risk. I think I would highlight two factors there. One, I think the amount of inflation that China exports to the rest of the world, so to speak, is a relatively small factor of what would be driving global inflation right now. And so I don't think at the margin it's going to be enough of a force to drive a big disinflationary process, particularly as I noted that a lot of the inflation we're seeing in major economies is domestically driven, is driven by services prices, which are going to be less influenced by global factors. The second factor I would highlight is we are at a moment where I do think the risks to China's outlook are to the downside, but we are seeing a fair amount of stimulus talk coming out of the government. We've seen some measures already from the Chinese government in terms of rate cuts. I expect more measures to come in coming weeks. So we haven't moved down our forecast from that 5% level. We still expect the government will be able to hit its target. And if growth comes in even weaker, I think they'll just ratchet up the stimulus even more until they hit that target. So I think at the end of the day, China's not going to be as strong as we thought earlier this year. But I also think there's a floor on where growth's going to be. And it's not going to be as weak as a lot of the pessimists are thinking.
Okay. Nevertheless, if you see from May onwards, the yuan has depreciated so much. Steve, what's your sense? Does it depreciate even more?
I don't think it's being encouraged. I don't think that the external side of China is kind of either the problem or the rescue the Chinese economy. I think it's a question of domestic demand and domestic confidence. There's nothing to stop them from going further. I think that there are some, perhaps some issues with Chinese firms with dollar debt that there might be some reason for policymakers to be conservative over the past. On the whole, I don't think that that's going to be. I think that the weakness of the currency reflects the weakness, domestically within China. It's not, it's an indicator. It's not a cause, and it's not a key force there. But I think that if we see any sign of Chinese rebound, the currency will strengthen and move much closer to 7. I think that the market is sort of expected and waiting to see both the policy measures and the effectiveness of those measures before really going out and buying CNH or CNY.
If they go on cutting rates, naturally it's going to impact the currency, and they have cut rates even today, albeit not as much as the market expected. But Steve, some in India believe that since India has a large deficit, trade deficit with China, the Reserve Bank will allow the rupee to depreciate to keep pace with the fall of the yuan so that our deficit doesn't increase. So do you see more weakness in the rupee?
Well, I'd say that you look across Asia, every currency. So I don't think that there's anything particularly weak about the way the rupee is traded. I mean, it did break 83, but it's not that much higher than the top of the ranges that we've seen over the last year. And again, I think sometimes we talk about the currency, but I don't think that the fate of the economy depends on it. But China has such a big presence in Asia. It's hard to see other currencies rallying a lot if China is weak. So I think, again, I don't think that the rupee will necessarily weaken a lot, but I think that it's, if you're looking for a big rally, if China, CNH is weaker, they continues to weaken, it's going to be hard to tell the rally story, not just for the rupee, but for.
Yes, take your point. China is such a big factor that if China is depreciating, it's difficult to see other currencies rallying. Not that India wants the rupee to rally. Robert Sockin, Steve Englander, once again, thank you very much for staying up for us on a Sunday night. They're joining us from New York. We have to wrap up on the note that the equity markets are still flat, but the mid-caps are up and away. On that note, it's a break and we hand it over to Chartbus.